Hi, it's Keith Akada here over at The Mortgage Reel. Wanted to bring you some great education on what to expect in the conversation of the appraisal contingency that you're going to have with your real estate agent. So let's jump right in. The appraisal contingency in today's market has three options that could be considered. The first is you're submitting an offer at contract price. If the appraised value comes in at the same contract price, great, you're proceeding. If not, you're going to receive earnest money is going to be refunded. To be competitive, and there's multiple offers, and this is the house that you really want to purchase, then there could be the discussion with your realtor of a second option of how you're going to structure your purchase and sales agreement. This one is where you're going to have gap cover fall. So that dollar amount you're going to determine with your realtor based on review of the comparable sales, your reserves, and what you feel most confident with. So that dollar amount, again, is something you're going to predetermine. If the appraisal comes in less, then you're saying, well, we'll cover this amount. Anything more than that, then we're going to rescind our offer, refund us our earnest money. The third option in today's market that we're seeing is where the appraisal contingency is being waived completely. But key thing to remember here is, regardless of where that appraised value ends, you're so confident, you're moving forward, the reserves are going to cover that shortfall. So if you're going to be very aggressive, or if you know that the comps are going to support that value, and when I say comps, that's all sold within the last 6 months, within 1 mile of the subject property, and it's like kind, right? Same square footage, bedroom and bath count. That's those comps you're going to be reviewing with your real estate agent. Now, to dive into the financing side, let's take a look at what happens here. Understanding purchase price versus appraised value. I use the model of $700,000 as a purchase. The borrower is going to originally consider a 20% down payment. The appraisal comes in at $650,000. Of course, we have a shortfall of $50,000 from appraised value to contract price. What's very important to understand is that all lenders are always going to use the appraised value to extend financing, not the contract price. So they're going to default to the appraised value. If the appraised value is at $650,000, still keeping in mind the borrower wanted to put down 20%, now you can see the down payment has reduced to $130,000 versus the $140,000. If that 20% of the appraised values are here at the $130,000, we have that $10,000 difference from original. But in this case, we now have that shortfall that we're still contending with. So when you add that back to the new down payment, we have $180,000 total. So some think that you're putting it on top of this. That's incorrect, because we have to factor in the down payment structure now based off of the appraised value, not contract price. There is another option to consider, and that's leveraging the financing in the event of a shortfall in value. Same model, $700,000, 20% down is that $140,000. Same difference here, we have that shortfall in value. Of course, that's $50,000. The rules are still the same. Now, if we're going to finance more, keep in mind that if that amount that we're financing goes higher, then of course you have mortgage insurance. So in this case, if we're putting 10% down, we have mortgage insurance. If the appraised value comes in at $650,000, now if we reduced it to 10% down, as I use this as an example, we have $65,000 that's going to be part of the down payment. Again, that down payment is calculated off of that $650,000 value. So now if we have our $65,000 down payment, we still have that $50,000 in shortfall. This is how we come to our new down payment of $115,000. So in the previous model, we had $130,000, not the $140,000, and now we're at $115,000. So we still have some cash in reserves that if we wanted to manipulate that and still use it, great. But if you want to take some of the pressure off, this is how we could leverage the financing, because our new loan amount is at 90% of the appraised value, right? So this is an option to get to the finish line at a 90% loan to value. You may be asking, Keith, why would we consider this? Well, if you're in a situation where that 140 was originally, that's what we want to have as a down payment. Well, now we're in the situation where you really love the house. This could be leveraged. Another option in thinking about this is if you have future income of bonuses, RSUs, which are restricted stock units, anything of a windfall of income or savings of the future that's not realized yet, this is the way to leverage it. Because if we finance that 90%, of course, we have mortgage insurance. Could you pay down the mortgage at a later time and then cancel and drop that mortgage insurance and not have to refinance? Keep in mind that you can drop the mortgage insurance at a future date. If you have questions on that, feel free to ask. But that is a strategy on how not to use everything that you have. And a lot of times with stocks or investments, we have to keep in mind there's capital gains of short and long term. That capital gains tax most likely is going to be more than what you're going to be paying on a monthly mortgage insurance. So is it better to let that money hopefully rise with your investments and do that at a later time? A possibility, but now at least we know we have options. So if there's any questions with this, please feel free to let me know. Thank you very much for your time. Have a great day, and we'll talk to you soon. Bye-bye.